All right, guys, we're at 5 past the hour. We're going to go ahead and get started here. Welcome, everyone. Thank you for joining us for today's webinar. My name is Nick Acchetti, and I'm a land manager here at People's Company, and also your host for today's presentation. People's Company is the leading provider of land services nationwide that includes offices in the Midwest, Delta, Lake States, Pacific Northwest, and West Coast regions. Our services include land management, brokerage, appraisal, and investments ranging from Washington to Florida and everywhere in between. People's Company Land Management is an asset management strategy utilizing farm-specific systems and practices to increase the property's annual income and produce premium appreciation. We take a different approach to managing farmland and do so in a socially responsible manner with sustainability, conservation, and water quality issues being actively addressed. Unlike traditional farm management, the PC model identifies progressive farmers that are aligned with the landowner's goals and objectives. The focus is on best practices and emerging technologies to increase the productivity and profitability of the farm and the returns through both regenerative land management and sustainable economic outcomes. This asset management strategy has a long-term focus that follows our 7-step process shown on this slide through collaboration with industry-leading experts. In today's webinar, we will be covering big questions in land management, and we'll touch on 4 specific topics, including farm policy, market updates, farm improvements, and carbon markets. By the way, our management team has been receiving multiple calls about 2022 cash rent prices and lease termination. We will be addressing these questions in our next webinar in mid-August, so stay tuned. Today, we have a great lineup of speakers from industry-leading companies and are very excited they're here to share their knowledge. But first, just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your control panel, and I'll bring them up at the end of the presentation. Our speakers will have time to answer. Now, without further ado, we're going to turn it over to our first speaker today, Dustin Johnson. Dustin has more than 14 years of experience working with large agricultural producers throughout the Midwest and Delta regions to mitigate farm price risk. He has been an integral part of designing the Ag Yield software, which helps manage farm margins. Dustin, are you ready to get started?
Yes, Nick, thank you. Yep, let me share my screen. All right. All right. So thank you for having me on today. My name is Dustin Johnson. I work for Ag Yield, which we do a lot of marketing for large row crop producers across the Midwest and Delta region. And you know, what I was going to talk about today was just a market update of how we got to this point, the reasons for the strong market that we're looking at today. There's a lot of them. It's actually a pretty long story to get to what we've gotten up to today. But that just helps paint the picture of where we could be going. In recent years, we've had very, very weak markets, and we've been thrust into this bull market that we haven't been accustomed to seeing since, really since 2014, that we've had this type of price outlook, not for just 14, but going to the years beyond. And of course, we all know what happened back then. We got this lull period for a while. So we're still getting our bearings straight as to what to expect. Is this just going to be like a 2019 situation where commodity prices are supported and then fall off? Or is this going to have some meat where it extends into the future for a couple of years? So with that, we're going to talk about 2018 to 2020, how this has been a perfect storm to bring us into this situation. It started with the trade war. We also had African swine fever in China that really decimated that hog population. And with that, the protein consumption that came with it. South America has really ramped up on competition, not just from the production standpoint. They certainly have more to actually ship and compete with us, but from their weak currency as well. That's been a huge disadvantage to US growers, and it's affected our price, which will show why that was the case. And then with the 1-2 punch, we went right into COVID-19, which clearly left a lot of drivers at home for the last year and a half. And that had impacted the ethanol market during that time. It was kind of the last straw to really keep us weak going into a period that should have been stronger had that not happened. So that leads into the 2021 market attributes, why we have such a supply and demand tightness right now on the supply side, and how that's it's mainly for corn and soybeans is the bigger concern for us. Wheat is really along for the ride. Certainly, we've seen a lot of wheat supply drop in the last couple of months, the projections of that. Part of that is from feed wheat, but it really is about king corn when we're talking about why wheat prices are supported today. And lastly is just inflation fears. We had the CPI data that came out today, and that's going to be a big part of what's driving a lot of the producers and also investors that we work with of why they're getting into commodities and why they're buying into this market. So let's start with the history of it. What we're looking at right now is just a chart of carryouts. We're going from a very tight supply back in 13-14 to that abundant supply into 16-17. And then, of course, that trade war is where the anomaly is. The top of this blue line is the soybean carryout. Without exports to China, we were left holding the bag with a lot of that soybean supply. And that's what crashed that price into the $8 to $9 range for a 2-year period. And a lot of the profitability that we've had to see from our end, which is the producer end, a lot of that's actually come from the stimulus, from those programs that really kept margins afloat for those couple of years, and certainly are not expected to be there now that we have a market with China again. But I did want to put this up just because wheat is on a whole different scale here than corn and beans, and we get a lot of questions about wheat. We don't think that wheat's going into as tight of a market, and really, if you're paying attention to wheat, it's really corn you want to watch. As far as that, the Chinese hog the population declined in China and around the globe because of China. We had that from 2018 to 2020. We hit a low of about a 14.4% decline on global pork production. So we're coming out of a supply deficit situation as they rebuild the herd. And that's part of the reason why the market probably wasn't prepared for that big of a jump back up on their demand. Lastly, the South American competition. This is mainly Brazil. Argentina has been coming up as well. But if we're looking at just what Brazil can produce for both corn and soybeans, compared to 2012, 2014, when we were looking at very tight supplies at that time frame, non-U.S. producers are about a 30% increase in total production. So this goes for both corn and beans. This is the third year in a row that we're expecting above 100 million metric ton crop out of Brazil for corn, and then certainly a fourth year in a row where they've really surprised us on how far they've caught up on production for soybeans. So when we were experiencing very low prices in 2018 through 2020, a lot of that was to do with the trade war, the ASF outbreak in China. We were looking at about a $8.33 front month soybean price not too long ago. When I say that we had South American competition, a lot of that had to do with the weakness in the currency at that time. So we were experiencing $8.33 soybean prices. They were getting up to a new record high that they had never seen before just because of their currency. So we had a very willing South American seller for the last 20 months, really, and their currency has continued to stay weak. So of course, what's happening right now is that their prices are exploding because of their weak currency, and our prices are exploding. So a lot of those producers are having a little bit of a tinge of regret that they've sold too much. And it's actually kind of backfiring a little bit. We don't have that natural seller that we used to have, where the next crop year comes along and there's a bunch of South American willing sellers because they're getting to new highs they haven't seen before. It's actually holding back a little bit, and it's holding some of the natural market sellers off of the market. So leading into this period of time, there's only a couple other times in history where we've had the price of corn, beans, and wheat as high as it is today. And that was for about a 30-day period back in 2008 when wheat really went nuts to the upside, and we had the $15 wheat, $20 wheat. And then again in 2012, of course, which is the 100-year drought that we all remember very, very dearly here. we're back up to these levels if you do a combined price of these three major commodities. And we just want to remind, kind of everyone that doesn't really stick around usually in history. Now, this might be a different situation. We might be going right into a weather event where we've blown through all previous record highs. But this is a very anomalous event. We don't see this very often. And I think this chart really sticks in our mind as just realizing how far we've moved in the last 9 months. All right, so this is new data as of today. This is the supply and demand sheet for corn. I don't want to get too much into the weeds for this presentation, but just want to show just what it takes to get down to the levels that we're at. Why we're up here is really the reason for this, for me displaying this. So we came in from a period where we're above a 2 billion bushel carryout for a while, 2018, 2019. 2020 largely was expected to be a 2 billion bushel carryout for a long period of time. We weren't expecting it to drop as low as it is. It's down to basically 1 month supply of corn. It's about 8.5% of our total usage for the year. That's the 2020 carryout, which ends September 1st of 2021. So this is today actually is the first day that the USDA is releasing the projected acreage and projected production for the year. They had some baseline estimates from the Fed report. They actually had to take total usage and drop it about 360 million bushels. And that's at a record yield of 179.5 bushels per acre. So this is 10.2% stocks to use carryout for corn. And the only way we're getting there is the USDA is already forecasting demand rationing. And we haven't really seen it yet. So this to us just says, well, there's obviously a good reason why corn is at $6 for the new crop contract today. We really need to find a way for supply to meet that demand adequately. And we need to see more signs of it right now because ethanol has been pretty profitable lately. But I wanted to also point out just between the difference between corn and soybeans, we're at a 10.2% stocks to use ratio projection for this next year for corn. For beans, we're only at a 3.2%. Beans are historically very inelastic, so it's harder for us to actually turn off that bean supply. And what the USDA is also telling us today is that they're not expecting crush to slow down at all. Even though we're at $14 beans, which they have this information, the USDA economist is still saying, hey, we still see crush working on all cylinders here. We think beans are going to have a very strong domestic market for that time frame, and it's going to be the exports that need to be rationed. So just going to kind of quickly go through global carryout. I think a lot of the dislodge is world stocks to use with China versus world stocks to use without China. We are very overly abundant right now. If you include Chinese numbers, we know that's kind of a facade. We're actually at very, very low carryout worldwide for corn and soybeans, and it certainly justifies this recent mark that we've gotten into. Same thing for soybeans as well. Very, very tight worldwide, even tighter. Tightest we've really been in this country, in the US. So when it comes down to inflation, I think the biggest thing that we're expecting is obviously inflation like everyone else. Today's number was a CPI report courtesy of Bloomberg. The biggest year-over-year inflation jump that we've seen really since 2008. So all of that's led by energy, and how that relates to corn is very important because that's the huge portion of the demand. Ethanol has climbed with heating oil and RBOB, and so long as we watch ethanol margins stay in the green, there's still that natural domestic bid there for corn, and I think it's going to keep a good market for U.S. growers. A true demand market is what that's showing to us. So, and this is, again, like I talked about some of the investors that invest with us trying to buy into the market. All of these ones, Bloomberg, commodity index, any commodity index you're looking at is at multi-year highs right now. And that is just that same tinge that we're seeing on our side of not just tight supplies, but those that want inflation exposure are getting into commodities still right now. All right, so just skipping ahead, last, I'm going to leave you at this. Forward demand outlook is what everyone's asking me right now. If you look at the curves are all inverted. So this is old crop corn all the way to new crop corn. We're looking at old crop corn about $7.25 a bushel. New crop is just above 6. We get out to DESA 23, we're back down to 450. So even though the market's projecting really good prices right now, it's not necessarily thinking that that's going to be totally inflation based. A lot of that's supply and demand driven. The inflation trade is all in that DESA 23 number, and that's why it's somewhat subdued, because inflation is not as high as what a lot of people are fearing yet. So I can get to that more when we get to the question and answer period. If there's any questions about markets going forward, I'll touch base on this exact question again. But I do think that it's not just about inflation. There's a true supply disruption right now, and that's why we're experiencing the bull market that we're experiencing today. So appreciate it, Nick. I'll send this back to you, and I'll answer questions at the end.
Dustin, we sure appreciate that. That was a great presentation. I'm looking forward to more questions as well. All right, we're going to roll into our next speaker here. We got Dave White. Dave White has more than 40 years of professional leadership experience in natural resource conservation with the Natural Resource Conservation Service and in the private sector. We're really looking forward to your presentation. Dave, are you ready?
Yes, I am. Let me share this. Am I up there, Nick?
You are here.
All right. Well, greetings to everyone. Thanks, Dustin. That was a great presentation. We're going to focus mostly on conservation policy for the next 10 minutes or so. Really talk about what lies ahead for private land conservation, the American Jobs Plan, climate change, 30 by 30, and the good old 2023 Farm Bill that's coming up. All right. Okay. First, why is private land so important? 70% of the lower 48 states are owned by you and me. 88% of all the water falls on private land. So really, the quality of our environment really depends on the millions of individual decisions private landowners and operators make every single day. And climate change is really causing some changes. Since 1980, we have had 291 weather and climate disasters where each of them exceeded $1 billion. Cumulatively, it's almost $2 trillion from those 291 events. What we used to call extreme weather is now unfortunately becoming somewhat of a regular occurrence. In this country, we have about 100 million acres of cropland that's lost its topsoil. And globally, it's estimated that the cost of land degradation is about $490 billion per year. This is a good example of one of those extreme events. This was the derecho last August. And I believe these are from Iowa, and I believe Cedar Rapids took the brunt of this. Let's talk about fire for a second. Our fire season in the United States is now about 78 days longer than it was in the 70s. And the Forest Service, their budget, the portion of their budget that fights fires, it went from under 20%, and now it's more than 50%. There was a study done last year that showed nearly 2 million homes are at risk of being destroyed by wildfires. And it costs about $638 billion to reconstruct those. This is from 2019. I think it's the Kincaid fire in Sonoma County. This is pretty scary stuff, and it's happening with increasing frequency. Let's talk about some of the proposals. President Biden's American Jobs Plan. This is the infrastructure plan. It's 2.1 trillion. Actually, I have to confess, I saw figures of 2 trillion, 2.1, 2.3, 2.5, and 2.7. I put them all in the hat and decided it's 2.1 trillion. Of that, they have designating 1 billion for USDA conservation programs, which is over 8 years, which out of 2.1 trillion is not a whole lot. And Senator Stabenow, Debbie Stabenow, she is the chair of the Senate Ag Committee. She has called that amount woefully inadequate. Other climate activities, the president has issued an executive order for all the federal departments to determine what they're going to do about climate change. And right now, USDA is currently seeking input from you and me and everyone else. You've probably heard about the carbon bank idea. There's not a whole lot of meat on that bones. We really don't know what it's going to look like. I can tell you right now that the person behind it is a guy named Robert Bonney. I know Robert. He is one of the most ethical, thoughtful, and committed people I know. So I'm pretty sure whatever they come out with is going to be pretty solid. On Capitol Hill, we're seeing a flurries of activities. And I want to take you back to last June. The House Select Committee on the Climate Crisis, the Democrats issued a majority report. It was extraordinary. It was 574 pages long. It was footnoted like you wouldn't believe. It covered all sections. Agriculture was like 32 pages long. So I think if you really wanted to see congressional thoughts on it, at least from the Democratic side, this is the document I would point you at. The Senate came out with one later on. It was not as detailed. And of course, we have new bills being filed regularly. The biggest one for conservation is the Climate Stewardship Act. That's been in the Senate by Senator Booker. He from New Jersey. He's a member of the Senate Ag Committee, and the companion bill is Representative Spanberger. She's from Virginia. She is the chair of the House Subcommittee on Conservation. This would take programs like EQIP, which is now 1.7 billion a year, to 7 billion. The Conservation Stewardship Program to 7 billion. It's a chunk of money. Senator Stabenow, Senator Braun in this Senate have their Growing Climate Solutions Act. That's got a lot of bipartisan support. That's likely to pass. Basically, that would just set up a program in USDA to certify third-party providers. So if a producer wanted to get into the carbon market, and I know Billy will be talking about this, USDA would say these third-party providers, their credentials are good. Representative Thompson, ranking Republican on House Ag, he's introduced the Sustain Act. This is really a unique approach where his bill would allow private sector to invest and leverage federal funds. Really an interesting approach. And there's new bills all the time. Then we have the 30 by 30 America the Beautiful executive order. Basically, we're going to protect 30% of the American landscape by 2030. And in this one, it's key. These 5 programs I have listed here or would be the workhorses that USDA would use. This particular thing calls for increased conservation funding, but it doesn't say how much. So the president has put out his skinny budget so far, but we might see more detail when they flesh their budget proposals out. Now, the Farm Bill funding that we have right now, it's currently about $6 billion a year. The big 5 is the CRP, the Conservation Stewardship Program, EQIP, the Ag Conservation Easement Program, and the Regional Conservation Partnership Program. These are the 5 that most of the attention will be placed on. And as we look out to the 2023 Farm Bill, in 2021, this year, staff work is beginning. There was a hearing on the House Ag Committee today, as a matter of fact. You're going to see a lot more hearings next year, both in Washington, D.C. and in field level. And then in 2023, you're going to see a real burst of activity, intensive work to finish the bill on time, because the 2018 Farm Bill will expire on September 30th, 2023. So Congress always has a pretty hard stop that they have to get their work done. So the outlook. I think something's going to pass related to climate or infrastructure. Not sure what it's going to be. Conservation funding is going to go up, but no one really knows how much. It ranges from the $1 billion in the infrastructure plan that Senator Stabenow says is inadequate to the $15 billion plus annual funding in the Climate Stewardship Act. I would watch Senator Stabenow for the middle ground. She seems to be able to thread the needle pretty well on the Hill. But the key thing here on whatever passes is that any additional funds now will become a part of the baseline for the 2023 Farm Bill. And I think that bodes well for conservation. And with that, I will turn it back to you. and stop sharing my screen. It's all yours.
Thanks, Dave. That was a great presentation. There's lots of things happening on Capitol Hill, looks like. Hold on. All right, next up, we've got Quint Shambaugh with Farm Improvements from Diggs and Associates. After graduating from Purdue University and co-founding Diggs and Associates, Quint founded and built a water drainage water management company while having a strong involvement with his sixth generation row crop farm where he was born and raised. Quint, we ready to get started?
I can handle it. Thanks, Nick. So as I click here, big thank you to People's Company and Nick. I'm looking forward to hopefully sharing some insight on capital improvements. There we go. So Diggs Associates is a water management engineering and consulting firm. Today, we're going to touch on a few different things. First off, what is a capital improvement and how do I maximize that investment? Things to consider with any capital improvement, and then just a few watershed innovations from Diggs Associates that could help you and your farm. So just from a 3,000-foot view, what is a capital improvement? I typically look at these things in terms of water on and water off of the farm and conservation. And for today's purposes, we're really going to concentrate on water off. It's kind of the hottest topic right now. So a little bit about water off and what a capital improvement is. So a water off capital improvement, you can really divide into two different categories. The most basic is surface drainage. So getting rid of all the extra water off the surface of a farm. This gets rid of large quantities of water, and these are the drains that you can see driving down the road, right? They're ditches, they're waterways. It's taking water from one farm to another and conveying it to a wide open source. Common ways to develop surface drainage are things such as land leveling, which happens a lot in the Delta, land forming, which happens about anywhere when it comes to building terraces or waterways or any type of land moving to convey water from one point to another. And then a lot of conservation is conducted through land forming and surface drainage. Subsurface drainage is just what it sounds like. It is moving excess water below the surface. This is regularly done through a perforated conduit. These are regularly referred to as tile, drainage tile, interceptor tiles, field tile. Some people refer to it as mulling or ditching. But what this is taking the excess water out of the soil profile and moving it to a designated outlet. So what is the financial impact of a capital improvement? There are lots of financial impacts, but the first and most important that we regularly see is increased land value. So we can't put a hard number on the increased land value, but we know that farms that have proper capital improvements sell for more. And farmland sales are still a local market. So regularly the producers in the area or the land buyers in the area know that a farm has a proper capital improvement or not. And those farms regularly sell for more. There's also increased equity in that farm without increased property taxes. So while you might put a few hundred or a few $1,000s into capital improvements on your farm, that will be reflected in your balance sheet, but it won't be reflected in your property taxes. Increased yields and ease of farming. So a proper capital improvement can increase your yields upwards of 10 to 30%. That's outstanding. The most expensive thing you're going to do to your farm, other than buy it, is improve it. So making sure to do the right capital improvement to capture the most out of that increased yield is very important. It makes farming easier and more productive. So what does that mean? That means that a farmer can go into a farm and plant it all at once, or they can work it all at once, or they can plan effectively for their crop year a little bit better. It's really a risk management tool. Increased rent and crop share. So for those of you out there that own farms and rent them or have them managed through the People's Company, farms with proper capital improvements regularly rent for more, and there's a higher percentage of crop share because you should be receiving better yields. And most importantly, capital improvements can be better for the farm and better for the environment. Proper capital improvements with conservation taken into consideration can effectively have less erosion. They can be more sustainable, and even more importantly, they can provide a situation where less inputs go into the farm to produce the same amount of yield. There are also opportunities for increased conservation within capital improvements. So we're talking about drainage water management, waterways, riparian buffers, saturated buffers, lots of different opportunities during the capital improvement process to improve the environment. Whenever looking into a capital improvement, one of the things that we encourage at Diggs Associates is to consider holistic water solutions. That means don't just include your water, but think about your neighbor's water or where your water is headed. Farms aren't on an island, and they don't care about property, and water doesn't care about property lines. So it is the most equitable, sustainable, environmentally friendly way to include neighbors' water and to work together whenever you improve your farm. So at Diggs, we want to consider every acre that could either cross your farm or every acre that your farm's water crosses whenever you're considering a capital improvement. It's economically and environmentally the best way to do it. And this is an example of a comprehensive watershed project that we conducted at Diggs. So the farm in the middle, the green farm in the middle, was a 120 acre initial hire. This turned into a 2,800 acre watershed where over 15 landowners, 3 farm managers work together to effectively and equitably drain a watershed and then provide their own conservation practices per farm. Sharing in this project made it much more cost effective and made it much more viable for everyone involved within the project. So now, things to consider. So anytime you do a capital improvement project, I want you to think about these things. First off, is the proper groundwork being conducted? It's like building a house. Without a good foundation, it isn't going to be a good house. So you start with the engineering. Do you know your soil? Has it been tested? Do you understand the subprofile? If you don't understand your soil, you're not ready to do any type of capital improvement, surface or subsurface, because it matters that much. Have you identified a quality outlet? Do you know where you're taking your water? Are you affecting a neighbor? Is it legal to take your water there? That's always important to check too. And then back to that watershed analysis, understanding what water comes to you and what water leaves you. And then reaching out to stakeholders. You know, are we looking at holistic solutions? Are you hydraulically appropriating cost with your neighbors? Do you have somebody effectively implementing this project? All very important in the groundwork stage. Then, what protections and insurances do you have as a landowner? Are you empowered? Do you have a long-term partner and a quality contractor with you? You need to make sure you do. Do you own your data from this project? You need to make sure you do. Do you have access to professionals, people that can provide quality conservation plans, people that can provide quality drainage water management plans, people that can offer multiple solutions that suit your farm and not just their individual business? All these things are very important. And then proper insurance. Does your contractor carry insurance for their workmanship? Do they carry errors and omissions insurance to make sure that if they design something ineffectively, that you're covered? And then their general liability. You want to make sure that you're not stuck holding the bag at the end of this if somebody gets hurt. You want to make sure that if, God forbid, something happens while the project is being completed, that you're not the one liable. A little bit more about protections. It's important to have contracts. I mean, we're dealing with, 4, 5, 6 figure, sometimes 7-figure projects here. So you want to have a contract with your contractor. You want to strongly consider easement contracts if you're sharing drains with neighbors and if your drains cross neighbors. And then you really want to consider maintenance contracts. What happens if your drain fails in the future? What happens if it's damaged? Who pays for that? Those are all things that you want to iron out in the planning stages. And then, are you part or is your farm affected by a public utility? So we're talking about windmills, solar, pipelines, anything subsurface, electric line transmissions. anything of that nature. Is your farm affected by that? There are both pre-remediation, so before they come, and post-remediation options for that. At Diggs, we offer solutions. I would encourage you anytime that you're looking at a public utility crossing your land that you consider what you might want to do with your farm. Don't just consider your existing infrastructure. Consider where you might want to take it and what you might want to do in the future. Because once that infrastructure comes through, you are exceptionally limited, especially if it's underground, what you can accomplish on your farm. And then just a few things, a few watershed innovations that I want to make everyone aware of. So a little bit about Diggs Associates, just so you understand us real quickly. What is most important is what we're not. We're not a contractor and we're not a material manufacturer. We're simply engineering and consulting. So everything we do is what is most equitable for your farm from an engineering and project facilitation aspect. We take an approach that all steps are conducted in-house, from topographical survey to design to bid takeoff, and then helping you select the proper contractors for your work. And all this is done with one point of contact in-house. You can simply, we have an interactive website where you can go select your farm, select your services. You can do it through us or Ag Analytics. And everything is plug and play with today's most up-to-date ag software. So you could overlay yield maps with drainage designs or engineered solutions. Patent pending web interface where we can pull sub-inch topographic data and start designing and estimating on your farm today. Everywhere in green, we can pull your farm data. And then for anyone interested in ROI, we have a machine learning and algorithm that takes into account your true topography, a hydrological analysis that is based off of soil science and soil profiles, flow accumulation, a 30-year predictive weather model, and then your yield data or your producer's yield data. And we can give you a per bushel actual yield increase if you were to complete the correct capital improvement on your farm. And with that, I know we're going to answer questions later. So I'd like to turn it back over to Nick and thank everybody.
Thanks, Quinn. Another great presentation there. You guys are knocking these out of the park. Next up, and our final speaker of the day is Billy Cripe. Billy is currently head of marketing for CIBO Technologies, an advanced technology platform focused on scaling regenerative agriculture and creating a farmer-first carbon marketplace. Billy, are you ready to get started?
I sure am. So thanks so much for the opportunity to be here and to share a little bit with all of you. And are we seeing? Let's see, which screen are we seeing here?
I can see your slide, Billy.
Perfect. So, so thanks so much, to Peoples for hosting us here, and Dustin, thanks for helping us, understand these really historic markets. Dave for helping to demystify some of the emerging conservation and policy implications that are going on Capitol Hill. And then Quint for giving us that overview of capital improvements and specifically about how to deal with watershed and water off strategies. I'm going to talk to you a little bit about your carbon shed or your emissions shed, and what we are going to do there is to just try and demystify in the next 5 or 10 minutes or so. What are carbon markets and how do they specifically apply to agriculture? So voluntary carbon markets are different from compulsory carbon markets, and these really represent a new and very exciting opportunity to actually create net new value for growers, landowners, and operators, while really promoting that long-term environmental and economic sustainability, really bringing those into alignment. So at CIBO, right, we are focused on scaling regenerative agriculture. And really that is this idea of combining all of the different management practices that go towards replenishing the soil, regenerating the soil that we grow in, which can include everything from crop rotation to low-till, no-till management and tillage practices during some years, to reduced inputs, and cover cropping of course. And there are a number of other activities and management practices that would fall under regenerative management, but those are really kind of the big ones. And what ultimately this does is it allows us to start to quantify and then to verify those activities, which actually have net positive environmental and soil health benefits. And those translate also into economic benefits, right? So as we reduce greenhouse gas emissions, whether it's from decreasing, say nitrogen applications, or one fewer pass with the with the tractor over the land, which means much less diesel being used, which means much less greenhouse gas emissions in the production and the refining of that fuel. All of these then translate into an economic impact, which can, show over years replenishing the soil, can boost yields, can create more climate resilient land and climate resilient crops, and ultimately improve land valuation and yields. And what it also does, and what is very popular now to talk about, as Dave alluded to, is the ability to produce and then to market and sell a carbon credit, and specifically a carbon credit that comes from these agricultural practices or these regenerative practices. And what is emerging here, both with CIBO and with a number of other organizations, is a new approach to doing the monitoring, the quantification, and the verification of management practices that lead to the creation of a valid carbon credit, which can then be sold and held and traded. The main force driving the need for this new approach is, while carbon credits are not new, they've been around for decades, actually, especially in the energy sectors. But agriculture is fundamentally different, right? It's an annual activity. There's all kinds of climate-related impacts that interact with the microbiology of the soils, and there's weather that interacts with the chemistry of the soils. And so all that has to really be taken into account when we develop a climate or an agricultural-based carbon credit. And so what we've created here is the new carbon credit. So generally speaking, these are measured in, one carbon credit is about 1 ton of carbon dioxide or equivalent that is reduced through greenhouse gas emissions reduction and or sequestered in the soil. And then that gets into what counts as a carbon credit. Well, the carbon credit has to, generally speaking, and then there's some squishiness on some of these definitions, which some of our policy friends in Washington, D.C. and at the state level will help us hammer out over the next months and years. But generally speaking, you need to hit these kind of 4 key pillars for creating a valid and sellable carbon credit. And it needs to have this concept of additionality, meaning there's something new that's happening. It wouldn't be happening anyway. There has to have this concept of permanence, right? The carbon or the carbon equivalent that is reduced or sequestered has to last for a certain amount of time. And doing the activity here can't force or can't automatically create an increase in climate negative behaviors or activities elsewhere. And then finally, it has to be verified. There has to be some science behind the verification to prove that these activities actually happened. Now, in agriculture, this concept of additionality and permanence and verification and leakage, these are really, really important, because agriculture is an annual activity. And so it's not like putting a smokestack scrubber on top of a refinery somewhere and capturing emissions and then compressing them and turning them into a diamond and burying them, under a mountain somewhere. Every single year, we're making new decisions about what management practices to put into place, whether that's, do we plant corn again? You know what, commodity prices are looking really good, like Dustin talked about. Do we spend the extra money per acre to put in a cover crop and maybe try and get some benefit, some carbon benefit from that as well? And do we do that every single year? And in agriculture, right, and in agricultural carbon credits, CIBO and others believe that every single year represents additionality and permanence. The decision to make an operating and a management decision happens every single year, which means every single year we have a new chance for additionality and permanence. So how are carbon credits and how are they generated? Right, they're generated by really reducing the greenhouse gas emissions, either by avoiding them, not doing them, or reducing the amount that they're used, and by proving that there is carbon or carbon dioxide equivalent sequestered in the soil. And so as we look at what CIBO specifically does, and this is very similar across other organizations who do similar things, is first we calculate what a potential could be for all the different farmland across the United States, the row crop land specifically. And we call this regenerative potential, but it says, look, under a baseline scenario, what is the difference between the baseline scenario and an ideal or a conservation scenario? The difference between that becomes the regenerative potential. When growers and landowners enroll in our process, they implement or they input their practices. It's quick and it's easy. Upload shape or boundary files to our system, and then we can start tracking and manage and monitoring what's going on. And we do this without setting boots on the ground and without putting feet in the field. We do this with our technology, with satellite technology and some computer vision, which means we use AI to interpret the satellite photos to be able to do things like detect when crops were planted, what crops were they, the crop detection, what were cover crops planted, what sorts of irrigation is in place, and what sorts of tillage is happening. All of those, once those practices are verified, then a carbon credit can be verified and ultimately put on the CIBO market or taken to another market. And in the CIBO's case, we do not own the carbon credits. The grower, the owner, the person who signs up for our program retains ownership of those carbon credits. So briefly, carbon marketplaces are really exploding all over the world, and it's important to kind of understand what the difference between those is. You've got institutional or compliance markets, as well as private voluntary markets. Those compliance markets are really about the right to emit some pollution. An organization says, I've done as much as I can, I'm still polluting, I need to buy credits from someone else, in this case, a grower or a landowner, an operator, that allow me, maybe I'm a refinery somewhere, an energy company, allow me to emit the pollution. The voluntary carbon markets are saying, hey, I'm going to do something to make the world a better place. Maybe I'm still emitting, but I want to offset my part of what is happening. This might be what's called insetting. Insetting is a new word. It's a little bit different from offsetting, but it's saying I'm going to help improve my supply chain. If I'm a company, maybe if you've gone to book airline tickets somewhere and you've seen, hey, you can offset the carbon footprint of your seat on that particular airline. Those are examples of voluntary carbon credits that are bought and sold on voluntary carbon markets. So as we get ready to wrap up here and turn ourselves to questions, right, we need to look at what are farm-based carbon credits. And these are the credits that come from the reduction of greenhouse gas emissions and the sequestration of carbon dioxide equivalents in agricultural operations and farm soil. And like I mentioned before, really it comes from the big activities, the big management decisions are things like cover cropping, low till or no till conservation tillage, reduced inputs, especially like nitrogen and things, inputs like that. And so how are these quantified? What CIBO is able to use really comprehensive ecosystem-based modeling and simulation to simulate on a daily basis the growth of crops in in any of about 4 million parcels of land in the United States, and then also use that computer vision, those satellite photos to actually verify what is happening on a daily and a weekly and a monthly basis, and then to determine those differences between regenerative management and conventional management. So we bring together, right, the key guidelines that are out there in the scientific literature, that are out there in the regulatory environments, and we do our computer science and our big data science, and we do the calculations, and then ultimately verify that those practices are happening, so that then the credits are available to be bought and sold, whether it's by individuals or by corporations who are trying to do that offsetting, right, the right to pollute what they can't themselves fix anymore, or insetting, the ability to improve their own operations, their supply chain, and individual consumers like you and me. So with that, I think we can wrap this up. There's a bunch more here, but I want to make sure that we do have time for questions and get to that, because I see a number of questions coming in. So with that, I guess I will turn it back to Nick and to Peoples.
Thanks, Billy. That was a great presentation. And sorry, I'm trying to find my screen here. All right, so I lost my screen. What? I need to. So yeah, we're going to roll into questions here, and we're going to start back at the top with Dustin, and we're going to work back through probably 1 to 2 questions per person, just because we're getting pretty crunch for time here. So with that, we're going to, Dustin, first question is, what do you envision grain prices doing this fall, and will they stay strong? And then the follow-up to that is, will the cost of production follow that?
Sure, thank you. That's a good question. Certainly a $1 million question. If I knew, obviously, we'd just be forecasting the market and printing money on it. Our best guess right now is that we are in a situation where we can't buy enough acres to meet the current demand, and unless something were to fall apart, like let's say we're to go back into lockdowns or something, where the ethanol would have to lose its value for the market to really fall out of bed. So we're looking at probably at least a 20% increase from baseline, with both crop insurance and sales that producers are making. We're seeing margins that we have never really seen before projected on our end. So I do think that it's going to be tough for the market to fall too far below $4.50 for corn and below $11 for beans, given the current projections. And that is lower than it is today, because there's weather premium that would be taken out if we have normal conditions. But it's certainly way higher than what we've had the last 7-8 years. So in that sense, I think it's going to stay supported.
What about the cost of production? You think that's going to follow?
Yeah, I mean, whenever there's meat on the bone, right, it's going to reflect that higher grain price. When I say we've never seen margins like this, it's an imperfect market. There's going to be a lot of increase. We've already seen it with the fertilizer markets. We're looking at, for the standard grower, let's say right in the heart of the Midwest, maybe Central Illinois, about $100 an acre increase is what we're planning on right now. And that's, of course, assuming the markets stay up where they are. We're already projecting $5 corn and above $12 beans for that next year as of today's price. If those stay, from our end, which is grower specific, we're planning on about $100 an acre increase.
Awesome. Thank you. All right, we're going to roll into Dave's question here. And Dave, what do you think will be the most significant piece of legislation under the new administration? Loaded question, I know.
Well, I think I don't mean to be flippant, but it's probably going to be the one that passes. My guess would be it's climate or infrastructure or something in that order. The key thing is every Congress, there's thousands of bills filed and only a fraction make it across the finish line. So I bet my money on climate, and I think it would be very good for agriculture, because anything that happens is going to increase the farm bill baseline which is very good for ag, particularly conservation aspects, which several of the speakers have mentioned.
Yeah, judging from your slide, it seems like Capitol Hill is pretty busy, so it's gonna be exciting to see where things head. So, all right, we're gonna go on to a question for for Quint here. What farm improvements do you think farmers are focusing on more specifically this fall?
I'm sorry, I didn't catch that, Nick. Can you repeat that?
Yeah, absolutely. What farm improvement projects do you think farmers should be focused on this fall? Is there any one that stands out more than another?
Yeah, so when it comes to farmland improvements, the most important thing is to understand your farm. So it really depends. I mean, it depends on your geography, it depends on your soil type, it depends on your operation. So, you know, if you're in, I'd say, the I states, chances are you're probably looking at a subsurface drainage program, right? With some light surface drainage. If you're in the Delta, if you're not already land leveled, you should probably be considering the options for subsurface drainage. But if you're not land leveled in the Delta, that's one of the most common first steps. So depending on your location, I think the most important thing is to find a trusted advisor and start to work towards a correct solution for your farm.
Great, thank you. All right. And then since we're running a little short on time here, we're going to get to Billy's question on carbon markets, which has been a busy topic of late. Billy, how much should farmers expect to make for their practices, and what should farmers expect to have to do for their compensation?
Yeah, that's the billion-dollar question. The price right now of agricultural carbon credits is market determined. And we see both on the CIBO marketplace and on other marketplaces that operate in a similar space, anywhere from $12 to $20 per carbon credit. And remember, one carbon credit is, generally speaking, the equivalent of 1 metric ton of carbon. Now, how many acres and what sorts of practices go into generating that 1 carbon credit or that 1 metric ton of carbon that's avoided or sequestered? That's going to depend on a whole range of things. And again, not to be slippery, but in the upper Midwest, you've got really, really rich soils. In other parts of the country, you have less rich soils, or you have different topologies and topographies that are going to create drainage issues and surface water areas where you've got more more stability challenges with the individual soil. Not all soil is is flat, black, and touching something that you already farm. And so what we see on average through the CIBO platform, and this is just what our data shows, is anywhere from about 3/4 of a carbon credit to 1.5 carbon credits per acre. And again, that is a very rough average. Your mileage may vary. It all depends on what your practices are and what the unique characteristics of your soil are. In addition to what sorts of management, what things are you doing? Are you doing no-till? Or that's going to be different than doing strip till or some other sort of conservation tillage. And so those are big decisions that every farm operation has to make the decision for themselves every year, because first and foremost, the farm is the business, and that's what keeps farms and farming families eating and keeping that business alive. We cannot, as a community focused on regenerative agriculture or carbon farming and climate change, we cannot ask and require farmers to bend the knee and kiss the ring of the of the environmental movement or the climate movement just to and ask them to go under as a business in order to make this happen. We have to economically and environmentally align the activities together. And that's really, really important. And that's one of the things I think that is starting to be reflected in some of the legislation and some of the bills and some of the rhetoric that we hear from Capitol Hill. Those are all very positive signs. But in general, we'd like to see the price of carbon credits, especially highly verified, highly reliable carbon credits, go up enough to create an incentive for more and more farmers to adopt these regenerative practices. And ultimately, I think that means the price of carbon credits has got to go at or above the price that it takes to actually implement the practices. We're not there yet. It's not a CIBO thing. It's not a technology thing right yet. It's a global market thing. And I think we are evolving in the right direction, but there's still more work to be done.
Great answer, Billy. And so we're getting short on time here. Just to let everybody know that this presentation will be sent out to everyone that would attend today. And I saw that Quint was actually already answering some questions and gave his contact out. So I'm sure if you reach out, nobody would have any problem following up on questions. But with that, we're going to have to wrap it up. And I appreciate everybody being here. A special thank you to our speakers and also our own graphic designer, Jenna, and our co-host, Kathy, for helping us put this all together. If there's any follow-up questions for People's Company Land Management, please shoot us an email at management@peoplescompany.com or give us a call at 855-800-5263. And remember to watch for our upcoming webinar in August, which will be addressing cash rent and lease terminations for 2022. Thanks again for joining us today, and we will see you next time. Thanks, everyone.